In Nigeria, the Liquefied Petroleum Gas Retailers branch of the Nigerian Union of Petroleum and Natural Gas Workers, NUPENG, has asked the federal government to intervene on the rising cost of cooking gas. Chika Umudu, who is the NUPENG Liquefied Petroleum Gas Retailers branch chairman, said this in his statement. He urged the government to intervene in the view of the current erratic power supply and petrol scarcity. So, can that happen? Joining us to discuss further, as well as the upcoming MPC decision on Monday, is Damilola Akinbami, Head of Research at Financial Derivatives Company Limited. Dami, good morning to you. Good to see you.
Good morning, Rotus.
All right. What do you make of this call for aid in LPG by the LPG division of NUPENG?
Yes, first of all, let's understand what exactly is causing or driving this increase in cooking gas and the price of cooking gas. Now, cooking gas is gotten from, when you refine crude oil, so it's a derivative of refined petroleum products. Also, you can also get or extract cooking gas from natural gas. Now, if you look at what is happening globally, one, the Russian war, the invasion of Russia into Ukraine obviously has driven the price of natural gas high.
Yep.
Yes. And also, if you look at it, Russia is the second largest producer of gas globally. Russia is also the second largest exporter of crude oil. So, Russia is playing a major, it's playing a major role. And now, another reason why we're seeing this increase in the price of cooking gas, domestic price of cooking gas in Nigeria, is also because of low domestic supply. So the first factor, the Russian war, we have no say or control over it. It's an exogenous factor. Now, this low domestic supply is where the Nigeria Liquefied Natural Gas Corporation is coming in and the plan to increase supply. Now, LNG is the largest supplier of cooking gas in the country. And initially, part of what it produces is being exported. But now what the NLG plans to do is to sell basically 100% of what it produces to the domestic market, just to ease the supply constraints. And bear in mind that this rise in cooking gas, it started sometime around November last year. We saw the price of cooking gas rise to about even over 10,000 naira for the 12.5 kg cylinder. Then early this year, there was some respite in prices. We saw a fall, a decline to about maybe 7,000, 7,500, because the government identified some of the issues and the constraints with the local production and supply. So now with what the NLG has agreed to do to transfer all of its produced gas, not LPG, to meet the domestic need. What that means that, yes, to address the supply deficit that is ongoing in the country, which could lead to a decline in the price of cooking gas. But bear in mind, like when I also said that one of the reasons why cooking gas prices are increasing is also because of the Russian war. So if that war continues, I know that there are peace talks ongoing and whatnot, but if the war persists, even if there's an increase in supply, the fact that, gas is still priced in dollars, and the price of, you get that LPG from crude oil and whatnot.
Right.
So like what is happening with diesel and whatnot, any derivative of refined crude oil will still be subject to whatever is happening to the international market. So even if there's an increase in supply, the fact that prices internationally are still rising, that may dampen the effect or the positive impact of an increase in supply. Also, the fact that the NLNG is transferring all of its production to meet domestic consumption needs, that means that you're not exporting, which has ramifications for the gas export earnings and the external balance of the country. Bearing in mind that our natural gas exports, they're the second largest source of our export and forex earnings. So on one hand, yes, it might address the supply deficit for LPG, but on the other hand, it would impact on our external position.
Thank you for that. The in-depth breakdown there. Dami, we've been discussing diesel rising, with blackouts, all these other things. What's the impact of yet another price rise in another commodity, this time LPG, on the average person?
Yes, so bear in mind that, if you look at the fuels used for cooking, you have LPG cooking gas, you have kerosene, you have coal, you have firewood. Now, yes, LPG price is increasing, but bear in mind, even because obviously once price of a commodity increases, people will switch to cheaper substitutes. So we're seeing that switch to cheaper substitutes like firewood, coal, which are not necessarily, they're not even environmentally friendly anyway. And we know what, there's this green energy revolution. So we're going to see that switch, which is not good for the environment. Also, kerosene is deregulated. So what is happening to diesel is also going to affect kerosene. And I don't know whether, I know the price of kerosene has increased, but obviously not as sharply as the price of diesel. So you're going to see that happen. So even the substitutes, the prices of these substitutes are not necessarily cheap. But there's another option, there's another alternative, biofuels, which I know that some Nigerian consumers are already using, which at least is cleaner. And I mean, so for instance, there's this ethanol-based biofuel which can be used for cooking. And I mean, ethanol can be gotten from sugarcane, and which we grow sugarcane in Nigeria. It can also be gotten from waste biomass. So I mean, that's another option that people can look at. So if the government can invest in that, I mean, like I said, we grow sugarcane, and if we can invest in the ethanol production, that would be another area or alternative to cooking gas fuel.
And thanks for that. Not sure if you heard, but I think it was either yesterday, the day before, it was yesterday. Kenya, going through the same thing, right?
Yes, they are.
Their government has decided to intervene in the LPG market. So they're doing what Nupeng's LPG division is asking from the federal government. I mean, I know you're a capitalist and you're a free market person, but what do you make of what Kenya is doing with them?
Yeah, so what the factors driving the price increase in Kenya's cooking gas, obviously the Russia-Ukraine war, also the government imposed the value-added tax, yes, and also dealers are basically trying to get higher margins. So those are some of the factors driving that price increase. And so what the government has decided to do is to intervene and allow its National Oil Corporation, which is similar to our own LNG here in Nigeria, to basically determine the market price of cooking gas. Bear in mind that in the past, I mean, the NOC was the largest or major player, but then in the 1990s, when the government decided to open up the market to the private sector, I mean, it lost its dominance and its market share. So now the government is going back to insist that, yes, at least 30% of imports would be controlled by the NOC. So basically trying to control the price of the commodity of cooking gas, and also to limit and discourage these profit margins that dealers are trying to address. So for Nigeria, I mean, it's similar to an extent, but like for us, I think our own major, because again, Kenya doesn't produce cooking gas. Right. They don't even produce natural gas, so they import all of it. So, but we still have an advantage in the fact that we produce it. So, I mean, with the NLNG increasing its supply, so to an extent that would address it. So it might not necessarily play out for us. And again, like you said, I believe in the free market. Yes, market forces. Yes, I mean, the fact that there's an opportunity for arbitrage and an opportunity for the major players to take advantage of or try and increase profit margins means that there's some inefficiency going on. So with the government coming in, I guess that would address it. But then again, market forces, the market is still a perfect market where there's competition, where there's price efficiency, is still the most ideal. But I mean, there's no ideal situation in any country anyway. Right. Yes. Thank
you for that. We'll switch now from cooking gas to monetary policy.
Yes.
There's Monday, I believe, the Central Bank of Nigeria is going to be giving a press briefing. And what are the factors that MPC can be looking at, economic backdrop for Nigeria as it deliberates on what to do on the benchmark interest rate?
Well, this meeting is occurring during, I mean, we will call it interesting times. One, I mean, we can see that the global monetary policy authorities now are actually begun to normalize the policy stance. I mean, for instance, the US Fed increased rates for the first time since 2018 by 0.25%. The Bank of England yesterday raised its own rates by 0.25% to 0.75%. And this is the third consecutive hike by the Bank of England. So we can see global monetary policy normalization already commencing. Now, for Nigeria, I mean, we're in a situation where the government is considering venturing into the Eurobond market to raise funds because of our deficit financing needs that are increasing. So in borrowing at this time where global interest rates are increasing, obviously that would have some impact on your debt service burden, that would have impact on your debt service costs. Now, with that said, we also have the unique situation of the political environment. I mean, it's a pre-election year. And typically in a pre-election year, monetary policy authorities try to maintain a neutral stance because they don't want to seem politically motivated, I mean, they don't want a situation wherein whatever decision they make could be termed or perceived as being in favor of the incumbent or whatever view. So usually what we see is that monetary policy authorities will adopt a neutral stance. So for Nigeria, yes, we have rising inflation, We have high energy prices. Our February inflation numbers increased. We have food prices still elevated.
Yep.
And I mean, there's so much. There's power shortages.
LPG.
Yes, LPG. There's water issues. So, I mean, there's still the forex liquidity issue also. So, I mean, the economic data is in favor of a tightening. But politically, it's not expedient. So I think the CBN is going to try and weigh all these options, and most likely they may consider a status quo.
And the status quo, of course, would be
leaving everything the same. Yes,
yeah.
The monetary policy rate at 11.5%, CRR 27.5%, liquidity ratio at 30%.
And in fact, we have the inflation. I think we just had the inflation numbers of that, of course, because we try to, I guess, balance all these conversations with the impact of the average Nigerian.
Yes.
These numbers you've mentioned, food, core. It's still a burden on the average.
It is.
Yeah.
It is. Yes.
But anyway, but if they so basically they are walking a tightrope.
Yes.
If you hike, there's factors that come with that.
Yes, borrowing costs would increase.
Yeah.
Yes, it would to an extent curtail inflationary pressures, but then it will reduce the availability of credit to the private sector, which I mean is necessary for SMEs and what have you. If you loosen, obviously, I talked about inflation increasing and what have you. So either way, it's going to have significant implications on the currency. It's going to have significant implications on the economy. So it's going to be difficult for the CBN to toe the line that global monetary policy authorities are adopting. Even South Africa increased its interest rate for the third time.
Yeah.
Yes, was it in January or February when it had its last meeting? But most of our other peers in Africa have maintained the status quo.
And there's still, and I'm glad you mentioned the Fed and also Bank of England. What about the whole funds being attracted to those markets by the simple fact that they've raised their rates?
Good point. So now that interest rates are rising globally, there's that risk of capital flight away from emerging markets like Nigeria. And so because obviously investors would rather invest in an economy where there's less risk and greater returns and what have you. So for Nigeria, the higher interest rates globally mean that your debt service burden, like I mentioned earlier, would increase. It also means that the external reserves would be at risk of further depletion. I mean, they increased sometime in February, but we've been seeing that steady depletion occur right now, which means further pressure on your currency. So for Nigeria, I mean, again, we were thinking of going to the Eurobond market to raise about $2 billion. And the thing is, once our debt service burden increases and investors perceive that we might be at risk of falling into a debt crisis, then credit ratings agencies might downgrade or consider downgrading our credit rating status. Yep. And what that means is that obviously our debt instruments become more expensive. It becomes more difficult for the federal government to borrow internationally. So I mean, it has significant implications for Nigeria.
So many dynamics. It's not easy. It's not easy being in that room making these decisions. But I guess we'll see how things turn out on Monday.
Exactly.
Damilola Akinbami, head of research at Financial Derivatives Company Limited. Appreciate you coming in.
Thank you, Otis.